audio test. I'm hoping we don't have the same audio issues we had last time. If not, I do have a backup plan in place. Let me know if you guys can hear me okay. Am I too soft, too loud, etc, etc.
Too far away to hold me. You know I'm the one who put you out there. Name in the sky, does it ever get lonely? Thinking you could leave without me. Leave without me. You know I'm the one who put you out there. And don't know why. Thinking you could leave.
How about now, Julian? I just try turning up the volume a bit. Oh, is it really? Oh, I was about to give up. Nice. I was about to switch to plan B. And no, I'm not referring to the 2021 plan B. It's time for Plan Mango. Swimming. Alright guys, let's wait for Mock to leave before we talk about anything that's important. Keep all the juicy stuff for post Mock departure. How's it going, Hosta? How's it going, Julian? We have Nantha in here too. I thought I saw Murli in here. Yes. Seeing things? And Chauvin isn't here either yet. What are you guys doing? Oh, there he is. I could sense you come. My spidey senses. Now we gotta wait for Philippe. Philippe, where you at, bud? I'm gonna tag Philippe. In the Mango Discord. Get your butt in here. Stan the man. There he is. He has like 2 IDs now. Stained and Stan. And Ashok. Don't forget Ashok. Can't remember everyone. AJ is probably asleep. How's the music now, Nantha? Alright, I'll be back. I'm gonna get some snacks. Those weren't chips. Those dark chocolate. I was just unwrapping it. Alright, so this is the final voice check before we begin.
What will we do when we get old? Will we walk down the same road? Will you be there by my side, standing strong as the waves roll over? When the nights are long, longing for you to come home. All around, the wind blows, we would only hold on to let go. Blow a kiss, fire a gun, we would need someone to lean on. Blow a kiss, fire a gun, all we need is somebody to lean on. Blow a kiss, fire a gun, we would need someone to lean on. Blow a kiss, fire a gun, all we need is somebody to lean on.
Alrighty, let's get this party started. Good morning, good morning, good morning, good morning, good morning, good morning, guys. My name is Sean Dexter, and I welcome you back. To the Mango live stream. My oh my, what a week has it been thus far. I'm expecting a few more exciting weeks this year. So if you guys did miss this week, not to worry. We have a lot more to come. I do want to give you guys a quick heads up. I am feeling under the weather today. I'm not at my 100%. In fact, I don't think I'm even at 50% today. I shouldn't be doing a stream, but I told myself that I would be doing a stream for you guys every Thursdays. So I want to stay disciplined on that. Remember the Mango word of the year, guys. Discipline over all else, which means even over our health. Discipline over health, right? Now, you guys know what I mean, though. You don't want to take it too far, but remember, this is the trumping word for the rest of the year. There are going to be times where you're going to break discipline, of course, but you have to get yourself back on track. As soon as you find yourself doing that, remember, Remember, the word of the year is discipline, and push yourself to stay as disciplined as possible over all other words, okay? Over all other words. So yeah, I'm not feeling my best today. I'm going to be trying to do my best, however, for you guys. I'm hoping that we can have a back and forth discussion today. Not because I'm feeling under the weather, but because what I want to talk about today requires that, right? I want you guys to think about things instead of me just giving it to you guys on a platter, because I could be wrong. I could be missing things. And a lot of what I'm talking about, I've not really put too much, I don't want to say, I haven't like, how do I put this? The analysis, or rather my thesis I'm going to give you guys today, is coming from just me accumulating a lot of knowledge over like years now, right? So it's very easy for me to have blind spots, very easy for me to miss things because I'm taking a lot for granted. But perhaps if I push it forward to you guys in a way where you guys answer questions, maybe you guys will show me where I'm going wrong, where I'm missing things. So that's one of the bigger reasons. But yeah. Let's see, who do we have in here? Wolvie's in here. How's it going, Wolvie? Krisha made it to the live stream. Good to see you in here. Who else do we have? Mystic Hodlers in here as well. Mock, Murli, Sherwin. Good morning, good morning, good morning, good morning. I don't even have the energy to pull off a good morning for you guys. Hey Carlo, how's it going, man? You're up late, or what time is it at where you are? Hey Tarag, thank you, man. I appreciate that. How are things in Australia now? I heard there was a bit of tension. I'm hoping things are better now. All right. Got my sparkling water, my nuts. Hey Candace, how's it going? Alright. So, let's see, what's on the agenda? What do you guys want to talk about? Do you guys want to talk about, do you guys want to start with Bitcoin, or do you guys want to start with what's on everyone's mind, which is the FOMC meeting that unfolded last night, I believe. Last night, my time. So, do you guys want to talk about that, or do you guys want to talk about Bitcoin first, and then we can go on towards that? I have kind of prepared something for you guys in regards to the FOMC meeting, in regards to them increasing their rates, how it really affects the markets, etc., how it has historically affected the markets, and how concerned should you guys be? How can we use what we know thus far to plan our trades, or plan our mindset more so, right? Plan our mindset moving into the trade opportunities that will present themselves going into the rest of the year. So we can talk about that to begin with, or we can start with Bitcoin. But in both cases, we're going to be sticking to some high level discussions today, like on the higher time frames. Also because, hey, we're about to close a month. And you guys know, Mango's all about those bigger macro ideas that lead to those big wins that everyone wants. Everyone wants a big win, but nobody wants to look at the big time frames. It's kind of ironic. I want the big wins, but I want it in 1 hour. Oopsies, I did not mean to hit that button. Give me a second. Alright. Nope, that's not it either. Alright, here we go. Oof, not the best picture here. There we go, that's better. try and adjust this. Oh man. Okay. So, what do you guys vote on? Do you guys want to talk about Bitcoin, or do you guys want to talk about FOMC? Murali says, feels like the Fed is just playing Elon games at this point. No, man, no. FOMC. Okay, again, like I said, I want this to be a little bit more for back and forth, so Wolvie says wanting quick wins may be due to being risk averse if you have difficulty handling risk over time. So death by 1,000 cuts. People rather lose that way. And that's exactly what the Fed is doing, right? That's how they're winning. That's their grand strategy, Wolvie, if you think about it. That idea, I want all of you to just stop for a second and just read Wolvie's comment there. He says, wanting quick wins may be due to being risk averse. You have difficulty handling risk over time. People are willing to lose money for sure, in a gradual way over the long run, right? As long as it's happening slowly, because in the short run, it feels like they're not losing that much, right? It's just a tad. Everyone knows they're losing money due to inflation. They know they're losing buying power due to inflation, but they're okay with it because in the short run, it's so minuscule, right? But time flies, man. Time flies. Well, you know it, it's 10 years down the road and you've already lost like 30%, 50% of your buying power. So keep that in mind and apply that to your trading too. And then understand that you guys are probably using that same mindset while approaching your trading. And that's where I derive my edge, right? Because I know that the rest of the market finds it really difficult from trading the higher time frames. They find it difficult to hold on to trend trades, and you can just get edge from that. And the Fed is doing the same thing. They know that people are willing to lose money for sure over the short term, right? Because we all know that it really makes it's irrational. It's irrational to be holding cash over a period of 50 years, right? But we consistently do it over time, and some people hold a lot of cash over time. So FOMC first, says Julian as well. So FOMC. Clearly the vote is in. Most of you guys want to talk about FOMC. Sach Yadav says 64 watching and only 25 likes. You guys make me so sad with that. Why only 25 likes? 50 of you. Wait, my math is so bad today. 40 of you. Oh man, I'm clearly not feeling well. 40 of you clearly are watching and dislike the video, but are too lazy to even do that. But if you like the video, hit the like button. Richard Cardano says morning to you too, buddy. So what specifically about the FOMC do you guys have questions about? Now I can talk about the FOMC, but I think if I put you guys in a corner and ask you guys to frame a question, that is a learning process on its own, is it not? Like, if you really have to think about asking a good question is sometimes hard to do. So actually, good questions are really hard to do all the time. So I want you guys to ask me a question. And again, you don't have to feel pressure to ask a great question. Just ask anything, right? Try to think about what don't you understand. If you can even put that in words, you're making progress towards your eventual goal of understanding how all of these things work, which is impossible, right? It's almost impossible to understanding the plumbing of the current financial system. At least I think it's impossible. Holy shit. When I study this, right, I keep finding that they keep adding new stuff, right? They keep adding new ways, new tools into their system, I guess, into the plumbing system to be able to do more and navigate through past hurdles that they struggled with. So they put in these new systems after doing a lot of research and thinking and brainstorming, and now we have to constantly catch up with that. So it's difficult. Don't ever expect. And I say this to Krisha a lot too. I tell her, don't expect to understand everything. Okay, just go into this journey with the knowledge, embrace the knowledge that you will not know everything, and there'll be a lot of gaps, where you're like, I don't understand this component entirely, right? So my thesis is that it works this way, but let's see how it connects to this that I do understand really well. So that's how you guys want to think about things. Once you embrace that you're never going to know everything, it's a lot easier to not get intimidated by all of this stuff. Okay, with that, I'm going to switch on over to our green list over here. I'm going to switch on over to the 10-year treasuries. Let's see how it's been doing over the past few days. Came down, bounced really well. This horizontal over here, by the way, guys, 1.73%, which is essentially the yields on your 10-year bond, is our weekly level, right? And the yields coming down over here, what does that really imply? It means that the bonds were selling off, right? The bonds were selling off for the past like 1, 2, 3, 4, 5 days. And these 5 days were essentially when the rest of the market was yields. I shouldn't be doing a stream. But yields going down over here essentially means that the bonds were actually being picked up while the rest of the market was actually panicking over the bond market. So just there was a bit of a profit-taking event going on over here, where a lot of people were thinking, you know what, this market is overextended in regards to how they are reacting to yields going up. Keep adding new tools to get chopped. What are you referring to, Krisha? Krisha is here with the support. Sean Tambia says, question, with the outcome that the rates would be unchanged, how did that translate to a dip? Was the market expecting a decrease in interest rates? Okay, so no. So the outcome wasn't. Oh, he's saying that rates at the moment is remaining unchanged. They never ever try not to read into. So first step. Try not to read into the noise that you're going to read through headlines, especially on Twitter, from people who have a large following but don't know what they're talking about. I'm not going to name drop here. Secondly, also be careful of headlines that you're going to read from financial news channels, and try to read into what was actually said and the message that was actually sent across to the market participants who are forward thinking, because the entire bond market, right, is very, very, very forward thinking. So if you think about everything that happened all the way from around November 2022, the market was pricing in rate hikes. Okay? They were expecting Jay Powell, they were expecting the Fed to actually start being very concerned about the inflation. Okay, and they were already pricing that in over here. And you can see that yields are going up. Essentially, bonds were selling off because the market was expecting rate hikes, and they were thinking far ahead enough in time, and putting on risk in that expectation, right? In that expectation. So now with that base case that, okay, markets have an expectation of rates going up because of inflation expectations also going up. So CPI came out, I don't know the numbers off the top of my head, but Julian will probably know, 6%, I believe, 7% in Jan. So rates were consistently going up month after month after month, all the way since July, right? So market has inflation expectations. That is the key word that you guys need to note. Okay, it's all about expectations. These markets are always forward thinking. They're always forward thinking. So in Jan, and this answers your question, Sean. In Jan, the Fed did not really say that they're going to be increasing rates immediately. They said around March, right? By March, they're going to start their rate hike increases. They're not going to, because they're firstly, it's not as simple as saying, okay, you know what, we're going to raise hikes, and in 1 or 2 weeks they start raising hikes immediately. They would like to stay away from that. Of course they can. They like to stay away from that unless they absolutely need to and act in an emergency situation. But it's more likely that they're going to all vote. They all have to come in and agree on how much to rate the hikes by, right? So the big decision was already made to start raising hikes. Now there's going to be a lot of back and forth discussion going on in the background as to how much they're going to be raising hikes by, which is why Jay Powell gave the timeline of by March we're going to start raising hikes, and we're expecting to see 4 hikes after that. Now that's what spooked the market, guys. Okay, that's what spooked the markets, because when you say 4 rate hikes, okay, it could mean that you're going aggressive, and this is where the story starts becoming a little bit more whole for the rest of you guys, right? When you initially say, okay, I'm going to be increasing rate hikes, or rather, I'm going to be increasing rates, and I'm going to do, let's say, 1 or 2 rate hikes, right? So, what does that mean? What does that mean? That could mean, okay, you go up to 0.1%, maybe 0.2%, and then 0.4%, 2 hikes, okay? That's the worst case scenario. Or maybe they get really aggressive and do 0.5 and each time, and you go all the way up to 1%. Now that's scary, right? Increasing the Fed's funds rate from 0 to 1%, that could be scary, but again, that's an extreme case. But now when you say, instead, if Jay Powell says, okay, I'm going to be putting in 4 rate hikes, that really stretches how far they can go by the end of the year, right? Because even if it is 0.2, 0.2, 0.2 each time, it could reach all the way to 0.8, right? What if it's 0.25, 0.25, 0.25? Well, that takes us all the way to 1% again, right? And that's freaking scary. What if it goes 0.5, 0.5, 0.5, 0.5? That takes us to 2%. So there was a lot of open-ended questions over there that needed to be answered as to how much or how aggressive they were looking to be with their increase in hikes, okay? It wasn't about increasing the hikes right now, or rather increasing the rates right now, having the rate hikes right now. It was about expectations of what is to come by the end of the year. Because you guys need to think about it this way. The market will try to price in as much as possible ahead of time before the rest of the market does it, because everyone's trying to front run each other. Okay, everyone's trying to front run each other. By that note, too, by the way, people are going to want to buy back into the market after they've seen that everything's already priced in. So that was the first meeting and the first bit of like information that we had. Okay, that the Fed was looking to have 4 rate hikes, but we didn't know how aggressive that they were going to be. That was an open-ended question that alone spooked the markets. Now, come this meeting, right? I'm not sure whether you guys got the impression that I got, but I got a very, very hawkish impression from Jay Powell, where he was very, very freaking. There was no doubt in my mind. Like, he was essentially saying, he kept saying this over and over and over again. Employment is really high, and inflation is really, really high. The economy is really, really strong. Okay. And then he compared it to 2005, I believe, or 2015's the rate hikes during 2015, I believe, 2015. He's like, back then the economy was not strong. Okay, and I'm going to show you guys very, very soon as to what they did during 2015, leading into 2018, 2019. The economy was not strong, the economy was not strong, and employment was not strong. This time, he's saying employment is really, really strong, okay? The economy is really, really strong, and inflation is really, really high. Remember what the Fed's mandate is. The Fed's mandate is to essentially keep inflation down, rather like keep prices stable, okay? Dual mandate, guys. Keep prices stable, okay, while keeping employment up. He kept reiterating over and over again that employment is record levels high right now. That everyone has a job. In fact, the labor market is really, really tight, in that everyone can find a job very easily if they want, because there are that many jobs available compared to the labor force wanting jobs at the very least, right? So he's like, this is the perfect scenario. This is what he's essentially saying. This is the perfect scenario in which we can raise rates and raise them aggressively. That's what he was saying, okay? So he was essentially saying that we are going to be aggressive because we have the perfect playing field to do so. Because according to his read on the economy, employment is really strong. So what does that mean? Remember, one of their mandates is that they have to keep employment up. But if employment is really, really strong, they don't have to worry about this while tackling inflation. Because these two are often at odds with each other, guys. If you tackle inflation, you're going to hit employment, right? because inflation is directly correlated to giving people jobs. Because think about, when is inflation a concern? When you give out a lot of money, or rather lending, same thing, right? Lending is essentially the creation of money in our current system. When lending is very, very easy, right? When I'm a company and I can borrow money really, really easily, I can go and expand my business, I can hire people, etc., 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 right? So that also has a correlation with employment going up, right? People are able to find jobs easier because I'm a business and I'm expanding my business because I am able to borrow money on the cheap from the Fed, from the banks that get their money from the Fed. But if you reverse that suddenly, right? Let's say the Fed starts tackling inflation because they're like, hey, we've given out way too much money. Inflation is really, really high. Well, there are businesses who are going to say, you know what? Those plans that I had for expansion, I'm going to cut those plans out. So I'm going to cancel all those jobs in the job market. And more so, what I'm going to do is I'm going to go ahead and fire these people over here that are costing me so and so money. Why? Because my interest payments on my existing loans have gone up. Right? Because the Fed has increased rates. If my interest payments have gone up, my costs go up. If my costs go up, I got to cut costs to stay profitable. And where do I cut costs usually? By doing layoffs, right? So the Fed has to always manage this. So they have to be very careful about targeting inflation, because then they're going to hit the employment numbers. But this time, they have leeway over here. And they can't let inflation get out of control, because expectations of inflation is already really, really high. Everyone's talking about it, right? Your Uber driver is talking about it. The pizza delivery guy is talking about it, right? Literally, they want higher tips now, right? So inflation expectations, that seed entering the mind, guys, can ruin an entire society, right? When people start expecting everything to go up in price, it can really start taking root. And if you guys listen to the press conference, you'll notice that at one point there was a question asked, and he specified, he was very specific in saying what's important is inflation expectations. We got to get that in control, right? Because what a lot of people, and I tweeted about this, by the way, guys, follow me on Twitter. If you guys haven't yet followed me on Twitter, follow me on Twitter. Well, what's my Twitter handle? Does anyone know my Twitter handle? Kusha, I think it's Mango Sean _. Yeah, Mango Sean _. Follow me on Twitter. I'm going to start posting on Twitter more often. I'm going to be posting insights on these kind of topics especially. But what people don't, wait, where was I? I lost track of what I was saying. Jesus, where was I? Okay. But yeah, long story short, Sean, to answer your question, the reason markets went down is because of J Powell's hawkish stance, in my opinion, that he had towards the rest of the year. They are very, very serious about increasing rates. And another thing that he said, if you guys caught that, another thing he said, if you guys caught that, was the markets reacted to what I said, to our plans. We were very clear, and he keeps, remember I talked to you guys about how they're going to use their conversations or their press conference meetings as a tool itself, without actually doing anything, without actually increasing rates, without actually doing any of their buyback program. And we can talk about that too, that's really important. Without doing any of that, they can get the job done. They can target inflation expectations without really increasing interest rates, without really actually taking liquidity away from the market by buying the bonds back. They can do that by literally just being very clear on their intent on what they want to do. And I think he let it slip over there, or he was sending out a signal saying that, hey, that was a signal within a signal, essentially telling people that our intent over there was to ensure that the market is pricing in what we are telling them we are going to do, right? He said, look what happened. We talked about increasing rates, and the market is already pricing it in, right? He said that. And then right after that, he gave his intent for the rest of the year, saying that the economy is really strong, employment is really up, and inflation is a problem. And he's completely turned around on his tone on inflation is likely going to be persistent. Inflation is getting worse. It's not better this month. It's slightly worse, but the trend right now is that it's going to keep getting worse. So keep that in mind, and also keep in mind that everything that the Fed, this is what I wanted to say to you guys, everything that the Fed does has a massive lagging effect. But yeah, I hope you guys understood that long-winded answer. So Nate Boy is asking about the buyback. Okay, and that's really important. That's actually really, really important. This is where things get. This is what's really important, guys. Okay, taking liquidity away from the market, and they're not talking about this too much. If you think about it, all the fuss is around the interest rates. And in my opinion, the big scare, or the big thing to be worried about, and the big thing that's gonna rock the markets for the next 1 year, is how smoothly can they actually quantitative tighten, right? Essentially undo all of those big asset purchases that they made from 2010 leading to 2013. They did a lot for 3 years, and then again they were forced to start in 2019, and then 2020, of course, COVID did I don't use any profanity over here, but they did a lot, right? A lot. So how do I okay, let's do a little bit of some history here. I'm going to ask you some questions. Okay, should I start with the questions, or should I just show you guys? Okay, so what I have over here, guys, is a chart of the Fed's funds rate, and I've actually annotated it out for you guys based on, I'm still going to keep working on this, and I'm going to annotate the rest of the history for you guys, especially if you guys are interested in this kind of stuff. This is a lot of work actually to actually go back and find the exact dates, but I enjoy it, but I want you guys to find value in it. Otherwise, I'm not going to waste my time doing this, right? So we can go all the way back to 2014, but I'll talk a little bit about what happened leading into 2014 too, so you guys get some context as to, and also, by the way, I'm going to show you guys the corresponding chart of the market SPY while we are going through the rate increases and the rate decreases, etc., etc. So we're going to start around 2014, 2013 and lead all the way to, well, 10 years. We're going to go through 10 years of price history. Sherwin's like, I was looking for something like this the other day. You're not going to find this anywhere, because I was looking for this when I started my journey, and it's nowhere, man. It's nowhere. You can't find this anywhere, because I was looking for this. And to be honest with you guys, I initially made this for Krisha, right? Because I wanted Krisha to get a proper history of everything that I've been studying and learning. But I also give her a lot of the information while I learn, right? But then I put this together for her, so she gets a better understanding. And I'm like, you know what? I think the seedlings will really value this too. And Krisha's like, yeah, I think the seedlings would really like this. And I'm like, what about doing this on stream? You think the folk on stream are going to like it, or are my viewers going to drop even further, go from 70 to 50 to 20 if I start showing them this? And then at that point, I'm like, you know what, F it, I don't care. I'm just going to talk about the stuff I enjoy. And if people want to learn, they can learn. Otherwise, they can go to one of the other shitcoin channels where people just talk about horizontals all day. But I think this is important. I think if we start understanding what has happened in the past, we will know what is likelier to happen in the future, right? The Churchill quote, where he says, the further back in the past you can look, the farther into the future you can foresee, right? Something like that, he says. But I like that quote because it does give you an idea of how things have panned out and things people missed in the past, and you don't want to make those mistakes. That's the least you can take from the past, not repeating the same mistakes, right? So 2013, does anyone know, do you guys, all of us were alive in 2013, do you guys remember the financial conditions whatsoever? Most of us were too young, right? But even if you were too young, I mean, if you weren't too young, do you really remember the mindset, the sentiment of the markets, the federal funds rate, etc., etc. Do you remember any of it? Okay, Sean says he was trying to pay for food and rent at the time. That's actually relevant to the conversation. Julian says, this kind of stuff is really interesting to me. I've been trying to absorb as much info as I can lately about the financial system and macroeconomics. Hey man, good for you. Really good for you. I'm glad to have you, Mango Seed. It's you, Sherwin, all of you seedlings actually, who are so interested in all of this. It makes me feel less lonely going through this journey. So thank all of you. I really appreciate being able to have these conversations with you, right, and share this knowledge with you. So it allows me to bounce ideas with you guys. Okay, so 2014 was when Ben Bernanke left the federal, basically he retired, right? He left the board of governors. He was the chairman. Bernanke was the chairman during the entire financial crisis. He was the guy who essentially introduced quantitative easing to America and essentially, well, put in place this massive system of liquidity that we are swimming in at the moment, right? He was very hell-bent on quantitative easing, even though he had people in his board of governors, right, in the FOMC, that weren't fully on board with the idea. Now, Ben Bernanke was also a scholar, or rather a student of the Great Depression. I think he wrote his final thesis in his PhD, for his PhD on the Great Depression. So he came with a lot of like economic clout, or rather like historic clout, where he was able to say, if the Fed had reacted in XYZ manner in the 1929-1930 Great Depression, we would not have had seen the Great Depression that we did see, right? And because he studied it on the matter, he had a lot of authority on the matter. So even though he didn't have majority support, behind closed doors, when it came to the vote, he got all the support that he needed, right? The board of governors, at the end of the day, they're always going to show a united front, okay? And there's a lot of lobbying going on too in the back. So you see, these months leading into March, there's going to be a lot of back and forth between all of the governors, right, and the chairman too, to basically push ideas, to be able to push what they think is right, or what they are being lobbied for themselves. We don't know what's going on in the background. Now, this may sound like conspiracy stuff, but we don't know, right? We don't know whether people have their alternative agendas, their ulterior agendas. So that being said, going back to the topic though, two of the governors that were actually not on board, or rather at least one of the governors that was not on board with the entire idea of quantitative easing, was Jerome Powell. He was a young governor back then. Jay Powell was not on board with the idea. He was a dissenter that essentially did vote yes, right, for political reasons, and of course because you want to show a strong front as a organization to the public. But interestingly enough, he wasn't on board with the idea. He thought it could lead to massive asset bubbles in the future. So right off the bat, the idea we get of Jay Powell is that he is not as much of a money printer, or rather he'd rather not print as much money as we'd like him to. The way we portray him, right, as the brrr kind of guy, Bernanke was the brrr kind of guy, right? Jay Powell was always trying to resist going towards that direction. All the way back in 2010, actually, always since 2010, he was the constant dissenter. And then come 2014, the other governor that you guys have probably heard of, that was also kind of hesitant about the idea, but always voted yes and always had Bernanke's back, was Janet Yellen. Okay, Yellen was on the board of governors during Bernanke's time, and while J Powell was still new at the board of governors, and then she took the leadership role. She became chairman, right, in 2014. But even she was against the idea of quantitative easing, or rather, she did not want to continue it for as long as Bernanke actually put it in place, right? Bernanke was pushing QE all the way back in 2010. Okay, it wasn't supposed to last that long. It was supposed to last 1 year, but they pushed it and pushed it and pushed it and kept doing it, because once you do it, the market keeps expecting you to do it, right? And once you stop doing it, the market is going to panic once you stop doing it, because they're relying on you doing it. They're expecting you to do it. And again, going back to your question, Sean, expectations are more powerful than actual market dynamics and economics. Narrative, expectation is that powerful in the markets. So the Fed kind of got trapped over there. Okay, but then Bernanke resigned and Janet Yellen came into power. Now, this is where, and I know saying came to power seems like a strong word, but in my mind, these people who are running the Fed are literally the most powerful people in the world when you think about it, man. They're literally, and now they're becoming even more powerful. They're about to become even more powerful if the CBDC thing actually goes through. But that's a topic for another day. Janet Yellen became Fed chairman, and the way she seemed to have approached things was in a very methodical and surgical way. Okay, because she became, let me mark it out for you guys. She became chairman in Jan 2014. So that would be here, right? That would be here. And you can see that interest rates, guys, they were kept low during this entire period. For 1 year, even though Yellen was a hawk herself, okay, she wanted to undo but all of the damage Bernanke had done, or rather, I don't want to put it that way, she wanted to undo all of the quantitative easing that Bernanke had put in place for his tenure during the Fed as Fed chairman. So she wanted to start undoing it, right? But for the first year, what she did was stop buying bonds. Slowly and surely, she stopped buying bonds. So let me take a step back over here, guys. Do all of you fully understand what quantitative easing at its essence really is? Okay, I'll try to simplify it for you guys if I have to, but do you guys all understand what QE really was? Because that way you'll understand what Janet Yellen was really doing. Yellen is a hawk. Yeah, exactly. Yellen is a hawk. And I'll show it to you guys on a chart, and I'll show you guys how important that is. So essentially, QE is just buying assets off the market and specifically buying bonds from the market, specifically controlling the further end of the yield curve, right? Basically trying to keep interest rates down on the 10-year, bonds, the US 10-year, especially because they want to push more aggressive economic activity in other parts of the market, right? They don't want people to be saving money. So what they do is, okay, you know what? To punish you guys for saving, we're going to take away your interest rates. And the best way to take away your interest rates is by putting upward pressure on the bond market. And remember, in our last stream, guys, I explained how bonds go up, yields come down, right? So if the bond market was going up because the Fed was buying those bonds, what's happening to people's savings account? The savings account is giving them less and less money, right? So that's what Bernanke essentially did. He pegged the 10-year yields at a rate that made it really, really worthless for people to actually save money in those accounts. So now Yellen wants to undo all of that, right? She wants to, start all those bonds that they bought and they put on their balance sheet. She wants to, because the Fed literally, I believe, quadrupled or I think they 6x'd their balance sheet between 2008 to or rather 2009 all the way to 2014, right? They 6x their balance sheet. Now, what Yellen wanted to do, or rather what the Fed wanted to do eventually, was to undo all of that damage, undo all of those asset purchases, and also start increasing rates again. So when Yellen came to power, what she did during this period over here, the first year, was she stopped buying bonds, right? So she didn't start selling bonds. Okay, she didn't start selling bonds, but what she started doing was she stopped buying bonds. Essentially, she stopped giving liquidity to the market and taking bonds off the market. Okay, she did that very, very slowly. Okay, and I want you guys to see. Keep that in mind. The rates, keep this in mind. The rates the entire time, guys, was pretty much sideways. Okay, was sideways. She didn't touch the rates at all. Okay, now we're going to go to the SPY market, okay, S&P, and we're going to see what the market did between 2014 to 2015. Let's go ahead and take a look. 2014 to 2015, I have it marked out right here for you guys. Let me switch to candlestick chart, and you guys can see that the market actually, as soon as Yellen came into power, by the way, as soon as Yellen became chairman, you can see the markets actually had 2 red months after having just up like a parabolic run from 2012 all the way to 2014, just a straight freaking line towards end of December. And that's when Yellen essentially, this is 2014, no wait, hold up, I'm a bit wrong over here. It was here. Right, 2014, yeah. So she came into power over here, and we had essentially still had up, and the month, right? As soon as there's a regime shift between one Fed chairman to another chairman, next chairman, the market goes through a moment of, or rather a period of hesitation or a period of uncertainty. They don't know how the next federal governor is actually going to, the Fed chairman is actually going to operate with the new market conditions that have been put in place ever since Bernanke came to power, right? And it seems like the market had a red month, and then again just went up for 1 year, and that's when the market actually started faltering. Okay, between 2014, end of 2014, right, to 2015, end of 2015, right? So let's go ahead and see what happened now again, just to cross-check with the Fed's funds rate chart. Let's go ahead and look at what happened between 2014 to the end of 2014, and then the beginning of 2015 to the end of 2015, okay? I'm going to go back here, and now we're looking at 2014 to the end of 2014, okay? Rates stayed flat the entire time, okay? But what was happening during this period? Yellen was actually slowly but surely beginning to reduce the amount of purchases that the Fed was making through the market. And through this entire period, right, she didn't touch rates at all. Okay? But what she was doing was slowly reducing the amount of bonds they were buying from the market. And then by the end of 2014, she was not buying bonds anymore at all. Now, for the next 1 year, what she did was essentially nothing. Okay, it was nothing. Why? Because the year after that, she tried to start tightening. Okay, she tried to sell bonds into the market. And let's see what happened right after that. This entire year, they were trying to tighten, and they couldn't. Because every time they tried to tighten, look at what the market was doing. Literally, the market was, it was almost as though it was like an engine that was trying to go, but kept coughing up and stopping. Because once you take liquidity away from the market really begins to start throwing up all of that toxicity that was put in. It's kind of like getting over having a long night partying and drinking, and then suddenly you wake up the next morning and you realize that, damn, the party's over and I got to get all of this toxicity out of my system, right? You go through a huge like hangover, right? And that's what it seems like the market was going through over here, like a massive hangover. And then instead of letting the market have its hangover and perhaps do this, right, which is what it was about to do, by the way, which is what was about to do, they said, no, we can't do this anymore. And they reverse course on the quantitative tightening. And they essentially, they didn't start buying bonds. But they stopped selling bonds. Okay. They reversed course on quantitative tightening and they stopped selling bonds, because I marked it out clearly over here. I said Fed managed to stop buying bonds by end of 2014, but they weren't selling yet. They tried selling right over here, guys. Starting the beginning of Jan 2015, they started selling and they couldn't, because soon they started selling, the market did this. So what do they try using next? Well, they start trying to tighten. They try to increase rates, right? Let's go back over here and look at the chart. This is 2015 now, guys. Okay, we're looking at this period right over here. Let's go Jan 2015 to Jan 2016. Okay, yeah. So Yellen, December 2015, Yellen begins to increase rates from 0 to 2.5, and the goal was to raise rates all the way up to 1.75% by 2016 end of year. But they only were able to get to 0.75%. Let me just go ahead and remove this horizontal temporarily. I'll put it back in a second. I want you guys to be able to read this. Okay, so over here, December 2015, Yellen starts to increase rates. Okay, they go from 0 to 0.25 on the first increase, right? The plan was to eventually increase the rates all the way up to 1.75% by 2016. But again, they were only able to get to 0.75%. Okay, so before I go any further, I want to be able to I want to ask you guys, or rather take any questions from you guys before we go any further, just to make sure that we're all on the same page, or if you guys are confused about anything. I'll take a sip of water too. Let me just pull up the chat. Hey Steve, how's it going, man? Okay, so seems that how does increasing rates differ from selling bonds? Okay, that's a good question. So when the Fed talks about increasing their rates, what they're doing is they're talking about increasing the federal funds rates, which is essentially the short-term rates. So the easiest way to put it, Sam, is that the Fed's mandate, by the way, okay, and this really ties into what exactly QE is. Okay, the Fed is supposed, what they're supposed to do is only control or have a target rate on the short-term lending. Okay, on the short-term lending, they want to control the price of money, and they do that by controlling the short-term market, not the long-term market. Okay, Ben Bernanke introduced that idea. It was done in the 1940s, but not to this extent. But Ben Bernanke essentially gave it a name and formalized the process by saying, you know what, we will not only control the short end, but we'll control the long end as well. Okay, so that's the difference, Sam. And by the way, they do increase rates by essentially doing the same thing, but they do it in the short-term market. Hey Murli, you're welcome, man. So Murli says, wow, Sean, it's amazing the way you have included the news with chronology. Thanks for doing this. This is super valuable. If you guys find this valuable, I'll go ahead and spend more time. I'll try to annotate all of the history. I mean, not all of it, of course, but as much as I can. And we can keep starting this together as a community. And we can be better than the rest of the communities over here that just want quick wins. We can actually, you know, learn how to navigate through the markets as opposed to just waiting for massive pumps. So going back to where we left off on SPY, remember what I talked about between December 2014, okay, and December 2015. Yellen actually tried to quantitative tighten by selling bonds, okay, because what they did during this period was essentially stop buying bonds. But I want you guys to also note that even though they stopped buying bonds, the market just kept going up and up and up and up. It was only when they started removing liquidity from the market, right? Removing liquidity from the market. That's when the market started to falter. Because remember, what did I talk about in the last stream? That liquidity is collateral. The collateral is used to take on positions. Often the collateral is used to take on margin positions. So what happens if I come and reduce your collateral? Well, you will have to reduce your margin position, right? So you start seeing the market stutter. You start seeing the market cough. You start seeing the market falter. And they probably saw this and they're like, you know what? We clearly can't sell. We clearly can't sell anymore at the very least, because if we keep selling, well, this could get really, really bad. And they were probably facing a lot of economic pressure, political pressure over here as well from the president, etc., saying, hey, this is not looking good, blah, 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 right? A lot of nonsense going on in those terms. But this is where it gets super interesting, okay? Then rolls around 2016, and Yellen clearly wanted to start increasing rates, okay? And they probably had a FOMC meeting, just like we had very, very recently, where they said, what? We are going to be increasing rates for the next year, or maybe the next 2 years. Clearly, we know that. Why? Because they said that right over here, saying that we are going to be looking to increase rates methodically, structurally, all the way up to 1.75% by end of 2016, right? That's what they said. That's what their intent was. That's what their posturing was at the very least. Keyword over there, guys. I've been using this word posture for a very long time now. Is because of my readings from what has happened in the past in terms of what the Fed intended to do, or what they postured to do, and what they actually ended up doing. Because even though they intended to increase rates to 1.75%, they only increased rates to 0.75% by the end of 2016. Oops, I was on the right chart. Yeah, right over here. So we had 2015, end of 2015 right over here, and 2016 would be end of market. Yeah. So their goal was to get to 1.75. Just think about this, guys. Their goal was to be here. $1.75. I don't get it. The goal was here, and they were here at the end of the year. That is a massive difference. Just think about this. Think about this. What does this show you? What does this tell you? This tells you that the Fed does not have unlimited power to do whatever the hell that they want to. Just because they say they're going to do something, they have to react to the market. That's why Jay Powell very specifically said that we have to be humble and nimble, right? He's essentially already admitting potential defeat by saying that we have to be humble and nimble, right? Back then, guys, when there wasn't as much debt in the market, okay? Debt to GDP wasn't that high. They weren't able to get to their target rate by the end of the year. That being said, Jay Powell might be right that this time around, conditions are different in that we have high employment, the employment market is really, really, really strong, and the inflation rate, losing my words, inflation rate is actually far, far higher, right? Back then over here, guys, they had the opposite problem when pertaining to inflation rate. Inflation was actually down. Inflation was far too down, in fact. In fact, that was the topic of discussion back then, if you guys do remember. Julian, don't mean to keep coming to you for all the answers, Julian, but Julian, you probably do remember that back in 2015 to 2017 era, the topic of discussion was deflation. Everybody was like, where's the inflation? Where's the inflation? In fact, we were seeing deflation, right? So inflation wasn't a problem here. Employment was not as strong, and clearly the markets were kind of coughing up as well the previous year when they did try to sell bonds, right? So different conditions, but the point is that the Fed in a way was already humbled over here, right? The target was 1.75, and that is a big difference, guys. That is a big difference in terms of percent. That is a 300% off their target. 300% off their target. So think about it that way. Insignium, how's it going, buddy? How's it going? How's it going? Sherwin says, so it's mostly about posture and expectations that makes the markets move, and the actual STP steps they manage to take to impact the longer time frames. Yeah, that's really important, Sherwin, because if you think about it, I want you guys to notice that when Yellen made the announcement, or essentially made it clear what her intention was in regards to increasing rates, look at what the market did for the next 2 months. The market panicked and had a dip of around 15%, right? 15% is a lot in traditional markets. So the market did falter. In fact, you could say that the faltering started far before then, right? But the market did falter leading into the end of the year. But what happened throughout the entire period that they were increasing rates? Think about, just look at what I've drawn over here, guys. What I've marked out over here. Yellen increased rates gradually from 0 to 1.22% during this entire period. Rates were going up during this entire period over here. Sean, could you please move the chart a little to the left so we can see the dates? I'm a little confused. What chart? My chart? Like this? I mean, do you mean my camera? Is my camera blocking it? Oh, I see what you mean. Like this, right? Is that better? So, Yellen was increasing rates throughout 2016. And by the way, they increased rates. She stayed in power. Yellen was in power, or rather was chairman, up until 2018, right? The beginning of 2018. And she increased rates essentially from 0.0% all the way to, let's see, 1.18. So they did get up all the way to 1.18. This is where she got up to, okay? That's Yellen. And that's when Jay Powell came into power. But let's see, before we talk about Jay Powell, let's see what Yellen did to the markets. Okay, while she was increasing rates, all the way from 0, by the way, she increased rates from 0, federal funds rate from 0 to 1.2%. What did the markets do? Markets did this. They had a dump leading into the announcement that she was going to start increasing rates. But while she was increasing rates, what did the market do? Rallied freaking 50%. And 50%, if 15% is a lot towards the downside, 50% is a lot towards the upside. So rates were going up. Market was going up too. What's the key difference, guys? When did the market actually falter? It was actually the QT. It was actually removing liquidity from the market that actually makes the market really, really throw up. Yeah, they do have So essentially the repo market is far more complex than we would like to think because of the shadow banking system that is now underpinning it, because hedge funds also have access to the repo market for the short term, the overnight loans, right? Because of that, liquidity becomes a far more complex issue, and their tools are beginning to become far more blunt, for lack of a better term, but they aren't as sharp as they used to be in that the Fed was able to essentially target the repo market with lower numbers of liquidity that they were either injecting or removing to be able to have a stronger impact. But now, because of the amount of liquidity available, they can't be as precise as they wanted to, right? So they've added new levers into the market, and one of those levers actually is the ability to add interest rates in the repo market, right? They have the ability to offer people interest rates in the overnight market, and they didn't have that ability before. All they could do was have a target interest rate that they could affect by essentially taking away bills from the market or buying and selling bills from the market, right? Now they can actually offer people an interest rate for taking away liquidity, right? They could say, hey, we'll take your liquidity and we'll give you an interest, right? And on the reverse, they could do the opposite, right? They could basically give you, or rather give you money, and yeah, you guys get what I mean. So again, oh yeah, another tool that they added recently was I'm forgetting. They added something else. So first it was, the reverse repo market, right? I kind of already baked that into the explanation, right? So first it was the ability to add interest rates to their lending facilities. Then after having a repo market, they added the reverse repo mechanism as well to be able to take away liquidity when there was excess liquidity from the market. So they keep adding these new levers that we have to fully understand how they tie into things. Yeah, so interest rates on the short-term lending, exactly. So Steve Rose says by the time that the rate hikes eventuate, it's already been priced in. So I think going back to Hosta's question, right? Do they have any more levers? That's a really interesting question, because the real issue comes in, or rather, what I think is happening, right, is this is one huge experiment where they are trying to fix what is broken by adding patchwork, right? And they're like, okay, this should work. They add a new patch, like a new pipe or something that connects things, and they're like, okay, this should work, but let's monitor to see what breaks the next time. And if it does break, we'll be ready to have a new fix, right? So each time they add a new fix, and they're like, okay, I think now everything should be under control and the system should chug along. And I think that's what they are doing, or that's what it feels like they're doing. And at the moment, they seem a little bit more confident in regards to whether the markets will break if they take liquidity away, right? Because in 2019, the markets broke when they did take liquidity away from the market, right? They tried again, and we're going to get to that very, very soon. And now going back to what Steve Rose just said, by the time the rate hikes eventuate, it's already been priced in. And if things do get priced in by then, and they realize that, you know what, inflation expectations have now tapered, right? People aren't really expecting inflation that much because we've hammered the market with just our posturing so much. That might be enough for them to reverse course on the idea of having increased rapid rate hikes, and instead of going 0.2, 0.2, 0.2, they'll go 0.1, 0.1, 0.1. So they'll increase rates very slowly, like Yellen did. And during the entire time that Yellen was increasing rates really slowly, by the way, the markets just kept going up and up and up and up, right? But leading into the first rate hikes, like Steve Rose just said, right, the market priced in everything. Market price and everything. Once everything's priced in, everyone's certain as to, okay, I have no other option anyways now. I'm looking around. I have all this liquidity and I need to put it somewhere. Maybe I should put it back into these tech stocks, these value stocks, Bitcoin, whatever. Okay, so should we go on now and talk about what happened over here? Yeah, Holmes, it's one freaking big experiment, man. It's a goddamn mess, experimenting with our lives. That's what they're doing. No, Pietro, I've not looked into that actually. I don't have too much information on that, or rather insight on that. Krisha says, so maybe more sideways until the free market forces take over in the bond. Until free market forces take over in the bond market. Essentially, yeah, I think so. So my base case, this is one of the reasons why I wanted to probably start with Bitcoin before we come on to this topic over here, because this is such a long topic, right? I wouldn't say I have a good memory, Ted. Sorry, T. Holmes, but I appreciate the comment. I have a really terrible memory, at least according to me. I wish I could remember things as well as I'd like to remember them. Tamwai says, could you say it's harder to price in QT as there's a kind of constant feedback loop of devaluing collateral? Wait, let me read that a little bit more slower. Could you say it's harder to price in QT? Okay, so you mean pricing in the idea of QT as there's kind of a consistent feedback loop of devaluing collateral. So essentially, Sam, if I understand your question, what you're trying to say is it's hard for the market to even fathom the idea of QT because so there are many questions within your question, because what you're essentially saying is because of the devastating impacts of QT, people are probably expecting QT to not happen, and because they're expecting QT to not happen, it's hard to price it in. Is that what you're saying? Chauvin says, I have to be AFK for a bit. Oh, that's unfortunate. We'll catch the rest of the stream right after. This has been amazing so far. Love the history and its impact. Hey man, I'm glad you're enjoying it, and thank you for joining us thus far. Catch you soon. Oh man, I keep telling myself that I will clip these, but I really don't have the time to do that, man. Like, you guys can do that, you know? Like, if you guys could help me do that, that'd be freaking awesome. If someone could volunteer from the community to clip out what you guys think is... Because imagine me doing this stream for like... Some of these streams are like 3 hours long. And then me sitting through my own stream for 3 hours after that. So they decided QE is ending again. They watched Monday and Tuesday opening bell. Hey Wolvie, that's unfortunate, man. It was good to have you in here. Thank you for joining. I'll see you in the next one, bud. Samway says, I mean, from my understanding, if liquidity is removed by selling bonds, then collateral in the market is devalued. Yes. So then people would have to de-risk further. Yes, exactly. Yes, exactly. It's a self-reinforcing force. It is damaging to the market, which is why there were a lot of proponents of not doing QE because of this very idea, right? Once you do it, you have to constantly keep doing it. You can't really reverse on that without causing a lot of pain in the market. And the Fed has not been able to reverse on QE. Like QE started all the way back in 2010. They were supposed to stop it all the way in 2012. But they kept doing it. And then they started doing it again in 2018. Man, this is really 2019. 2019. This is 10 years after QE began. They were initiating new ways of doing QE and not calling it QE. So there was a big joke running around the time in 2019. You guys probably remember it was called not QE, right? Because Jay Powell came on stage and literally said, I want to be very, very clear on stating that this is not to be confused with quantitative easing. It's exactly like quantitative easing, but it's not quantitative easing. That's what he was saying. It was pretty funny. In every way, it looks like QE, it feels like QE, it smells like QE, but it's not QE. Yeah, Sam, you actually nailed it, man. That was well said. Hosta's right. What did Hosta say? The Hosta says, you mean the effects of devaluing collateral compound, so it's harder to predict the impact. Yeah, you guys are both right. Yeah, it was supposed to be short-term QE, called not QE. Okay, so let's go back to our discussion, guys. Okay, so Janet Yellen actually did a pretty good job of increasing interest rates while letting the market also keep going up. So everyone was happy, right? Everyone was happy. Interest rates were going up again, and markets were also going up. Like, maybe markets could keep going up and interest rates could eventually get all the way up to maybe 5%. Who knows? I doubt that would have been possible. But at the time, things were looking good. And what happens? Who remembers what was the most pivotal event of 2018, right? End of 2017, besides Bitcoin going to 20,000, and the beginning of 2018. Tan says, do you know anyone who actually has a theory on how to resolve this if it requires decades? Even if it requires decades, I'm thinking it's just best to let everything go kaboom and reset lol. No, I think and this may sound biased, but I think the best way to resolve the system is a slow transfer to a new monetary system that can be relied upon, and that we all know the only solution, or rather the only monetary system that has a monetary reliability, right? Or rather has a policy that can be relied upon. So there needs to be a slow, gradual transfer onto the new system without doing it. It needs to be what Ray Dalio would call a beautiful deleveraging. There's going to be some pain, of course. There's going to be winners and losers in the system, and that's like almost every pivotal transition from one economic system to another economic system has winners and losers, right? And it's painful for some. Some people don't even know that they're going through the pain, though. think about 1973, right? A lot of people lost a lot of purchasing power during that inflationary decade, and a lot of people made a lot of money by being in gold, right, during that period. So winners and losers through every economic, like think back to 2008, 2010, that entire period. By the way, anyone who was in assets made a lot of money, and people who were on the other end of the economic spectrum, right? Unfortunately, the rich got richer and the poor got poorer, right? There's always winners and losers, and this is why you got to keep yourself financially educated so you can be positioned for when that system starts having its transition. You're ready to take advantage of it, or at least not lose out, like a lot of people. Like, when the poor get poorer, man, it's really painful to see, and it's angering. It's effing angering. So, okay, but let's go back to this topic over here, guys. The big thing that happened in 2018 was that Trump essentially dethroned Yellen. Yellen was probably going to be Fed chairman for a long time, because she had not only Bernanke support, but she also had Jay Powell support, and she had almost everyone's support in the board of governors, right? People really respected her, looked up to her, thought she was really smart, and she knew her shit, right? But Trump did not like her. Jay Powell, on the other hand, was a very political guy. He knew how to maneuver clearly by not crumpling any pillows or anything like that, right? Whatever the phrase is. But Trump essentially said Trump and Yellen were on the same page in regards to how to go about undoing QE and QTing. But Trump did not like Yellen, clearly, because she got removed, and she just left the Fed, the Board of Governors after that, and Jay Powell came to power. Jay Powell, on the other hand, okay, didn't seem, at the very least, to be as tactful or as subtle or as surgical as Yellen was, or as patient as Yellen was with his undoing of QE. You can clearly see it in the way he approached his term as chairman. Right off the bat, he starts trying to reverse QE. He tightens and sells. He was selling on autopilot. Look at this, guys. I wrote it down here. I annotated it for you guys, saying Jay Powell tries to reverse QE. He was tightening, which was essentially selling, okay? And he was increasing rates at the same time. So let's go back to the Fed's funds rate chart, and mark out the Jay Powell era. And look at the steepness. Look at the steepness of the interest rates increasing during Jay Powell's term. You guys see that? So it went flat for a bit, and then look at that. But he wasn't just increasing rates, guys. He was double tightening. Okay, remember, Yellen was doing only one end was targeting only one end of the two, or rather one end of the levers, right? She was only tightening, only increasing rates. Jay Powell was actually selling on autopilot month after month, every single day, actually. Every single day. He used the word autopilot as well to show how serious he was. And the market clearly did not like that. The market freaking got spooked out. They're like, how much longer is this going to go on for? And at one point, all that liquidity being sucked out of the market really just tore the market apart. And right over here, you guys can see how he had to reverse course, right? So there were two big events during Jay Powell's era. There was the 2018 reversal, and then there was another reversal in 2019 with the asset purchase program that he had to reintroduce. And I believe that was, yeah, that was here. I haven't marked it out, but I'll mark it out now. Oops. Yeah, so you can see how things really started. It's almost as the market was foreseeing COVID happen, right? Because around 2019, I believe it was March 2019, somewhere around here, the yield curve inverted. Was it 2009? Yeah, the yield curve inverted around Feb or March 2019. And the yield curve inverting is usually, it's actually a strong signal thus far. I believe it has a 100% success rate and it has happened only around 7 to 9 times in the history of the markets. Only 7 or 9 times the yield curve has inverted, and around 1 year later you have a massive recession, right? And you can see like the market's kind of coughing during this entire period, and then COVID hit, and then boom, right? Everything went to shit. And okay, let's take things step by step though. J Powell comes into power Jan 2018, starts increasing rates and starts tightening, essentially taking liquidity away from the market. What did SPY do during the entire period? This was the J Powell era. SPY literally just went sideways. Pretty much, okay? We had this, I remember this blow off top over here, or rather this breakout here. It was such a hunt, right? It ended up being such a hunt. And then, of course, COVID hit. Then boom. So, this entire period, you guys can see that even though J Powell was essentially double tightening, the market did cough, the market did puke, the market did have some very, very ugly drawdowns, but it kept recovering and was trapped within a range. There wasn't enough of a catalyst, not enough liquidity in the market for the market to just keep going, but the market kept recovering. Why did it keep recovering? Because each time the market did cough, J Powell had to reverse course on what he was doing. Right over here, guys, the Fed had to pivot. This entire period, he was essentially very, very hawkish, saying that we're going to continue increasing rates all the way back up to normal levels, and also normalize our balance sheet. What does he mean by normalizing your balance sheet? Essentially means that all of the assets that we bought, we're going to undo it and we're going to sell it back into the market, right? And look what happened. This was a massive drawdown at the time. 20%. And again over here, the market humbled him, and he had to come out on around Feb. Was this Feb? Yeah, Jan. So around Jan to Feb 2019, beginning of 2019, he had to say, okay, you know what, we're going to stop the asset purchase, or rather the asset selling program. Okay, we're going to stop the asset selling program. Now, he didn't have to say that he's going to start buying again. He just said that we're going to stop selling. Okay, let's go back to 2019. Let's mark it out. So in this period was right here. So this, I have marked out over here actually. J Powell tries to reverse QE and tighten bonds on autopilot, okay, between this period here and this period here. This was the entire era on the charts marked out from here to here. And you guys can see that the markets were actually coughing and spluttering during the entire period, and they had a massive drawdown. But even then, we had a few months of up, and then boom, right? But on whole, the market pretty much just went sideways, right? There was a lot of pain, a lot of volatility during that period of taking liquidity away from the market, right? Because when he was taking liquidity away from the market, some people are getting really scared. Some people are like, finally, the Fed is doing something right, and then getting more confidence in the market, and they're wanting to come back into the market. There are a lot of people who left the market saying that I want no piece of this QE bullshit. Only if the Fed starts behaving well will I come back to the market, right? So there's a lot of sideways action going on over there, because there's some people getting liquidated, some people saying I want out before I get liquidated, other people coming in because of what the Fed was doing, etc., etc. So up and down, market capitulation, and then the Fed reverses course completely. Interest rates go sideways. But remember what I told you guys, all of that liquidity that they were removing is going to have a lagging effect. The market, I tweeted about this, right? The market will often have a knee-jerk reaction. Okay, the actual market will have a knee-jerk reaction to, when I say actual market, I'm referring to the market participants, okay? They will have a knee-jerk reaction to what the Fed is saying, what the Fed is doing, or rather what the Fed is saying about what they're going to do. So for example, most recently, J Powell said that he's going to have 4 rate hikes, and the market immediately overreacted and sold, right? Because they're trying to price in what is going to come in the future. But the true effects, guys, happen only like 1 year later or 8 months later. It takes a long time for the true effects to happen. They lag. The true effects of every action the Fed actually takes, it lags by months, if not years. I'll show you two instances of that. The first instance is right over here actually, where let me pull up SPY. So the Fed pivoted in 2019. Okay, they pivoted in 2019, beginning of 2019. So all of 2018, they were removing liquidity from the market. Okay, they were removing liquidity from the market. That liquidity that they removed from the market only showed up in a massive way in September 2019, which was here. Now you can't see it on the charts. Okay, you can't see it at least in the equity market, but the repo market blew up, where the overnight lending rate went up 9%. 9%. Okay, the target rate at the time was around 2%, 2 to 2.25%. The Fed is supposed to keep the cost of money, okay, the cost of short-term money at that time, okay, not now, back then, 2019, the Fed was supposed to keep it at around 2 to 2.25%. It went up to 9%. This threatened massive hedge funds to go bankrupt overnight, over effing night, because they were essentially abusing all of the liquidity that was put in place over the last like 10 years, okay? Now, the damage that the Fed did, or rather, the undoing of the QE that the Fed did in 2018, only took place, the damage was only seen 1 year later, guys, when the repo market blew up because of the lack of liquidity in those markets. Do you guys remember that? Do you guys remember the 2019 repo spike? Okay, just look it up. 2019 repo spike. That was the cause of the liquidity that was removed in 2018. The markets couldn't handle it. They tried to QT, and the markets threw up. Julian says yes, or rather I learned about it recently. Are you talking about QT? Yeah, so the shadow banking repo spike, essentially the overnight lending market was extended to the hedge funds as well, and they were essentially using the shadow banking system in conjunction with the repo market to be able to get all of the liquidity that they wanted to put on this trade called the basis trade. I kind of explain what the basis trade is in my video called Bitcoin funding rate. Very similar concept. If you guys haven't watched my Bitcoin funding rate video yet, please go ahead and do watch that. You guys will learn how the futures markets work and how you guys can take these risk-free trades, and now you guys can understand how those risk-free trades can also potentially backfire in a massive way if things go wrong, right? And essentially the liquidity that these hedge funds were relying on to be able to facilitate those trades was suddenly at risk, and essentially threatened to blow their entire business apart. So the Fed had to come and essentially bail those guys out by injecting, I think, $500 billion into the market in 2019. Okay, this was here. Okay, so all that QT that they did, it didn't mean anything, right? At the end of the day, right? In fact, let's try to. Can we pull up the Fed balance sheet over here? What's the ticker? Could someone find the ticker for me? Is it this one? Jesus Christ. I don't think it's this one, is it? Yeah, it is this one. So you guys can see what happened here, right? 2000. Oh, look at this. Look at this. This is exactly the story I just showed you guys, right? They tried to tighten all the way 2018. And then the markets threw up, and boom, so much for the tightening, right? It got even worse. Each time they try to do, they try any sort of tightening whatsoever, they have to do more after. Each time they try, right? What does this tell you? This literally tells you that as long as you don't get liquidated out of your leverage trade, right? In the long run, you can take advantage of this. Jesus, my throat is burning. Yeah, Julian, on that, man, I was shocked that they have the audacity to say that. You'll have nothing and you will be happy. Oh, crazy. So if you guys are enjoying this live stream and you enjoy this kind of content, make sure to hit the like button, and if you haven't yet, make sure to hit the subscribe button. That way we know to do more of this kind of content. I'm gonna still do this kind of content either way, but it's encouraging either way. So make sure to hit the like button, leave a comment underneath the video too to show YouTube that you guys are actually enjoying this content, because, well, YouTube tends to be punishing whenever we do this kind of content, because YouTube thinks that you guys don't enjoy this content. Julian did post a video between Robert Breedlove and I keep forgetting the dude's name, but that dude is supposed to be an expert on the Eurodollar shadow banking system. I was supposed to watch that video too, Julian, so yeah, I'll try to get to it this weekend. Tan says, hey Sean, what are your thoughts on the Great Reset theory? I'm personally keeping an open mind on it. What is the Great Reset theory? I'd love to know what the Great Reset theory is. I don't know what the Great Reset theory is, and I feel a little bit guilty for saying that, because I should have looked it up by now, but I'm not sure what they mean by the Great Reset. To me, the Great Reset is on Bitcoin. I'm not willing to entertain any other ideas. No, I'm joking. Of course, I'm willing to entertain other ideas, but I just don't see them having it their way when we are the ones coming into power, the millennials. I don't see them. I don't see them having their way. Just doesn't make sense. Hey, backs off. Yeah, we'll take a look at altcoins in a bit before I wrap up the stream. But at the moment, I just want to wrap up this conversation on the history of how markets have played out in regards to the Fed funds rate. And I'm just going to give you guys a quick high-level view on my ideas for Bitcoin this year. Then we can look at a few altcoins and then we'll wrap up. I came for the music, but the convo got deep. Have you been on any of the other streams, Holmes? Marin says, these claims originated from WEF video 2016 that stated 8 predictions about the world in 2030, including, you'll own nothing, you'll be happy, what you want, you'll rent, and it'll be delivered by a drone. The thing is, humans fundamentally want to own, right? We want to own things. We don't want to rent. We feel this. We feel proud to own things. So, overall quality of happiness, or rather, the misery index is likely going to go up, right? Does that make sense? What I think is going to happen is millennials are going to be putting in Gen Xers in power who are willing to put in the policies required to have a transition of wealth transfer mechanisms in place from one generation to another generation. And then once the Gen Xers get, Gen Xers are going to be very compliant in putting those policies in place, and while they're in power, they're going to be compliant. And then when the millennials get into power, they're going to be essentially building a brand new world for their children. So think about people like Wolvie, who's probably not here anymore, he's probably left, but Vishal, etc. They're going to be building the world for their kids, so that their kids are not going to have to go through the struggles that they've seen their friends go through, right? So the people who come to power are going to be a mix of people who had to struggle and people who had to watch their friends and family struggle, right? They're not going to want the children to go through that, and they're not gonna like this current system, man. Just think about it. Think about it through that perspective. Julian says property rights are fundamental human right, which is why I am a Bitcoiner. It's that idea that is so fundamental to Bitcoin. Property rights, because that is the first human creation that cannot be taxed just by ownership, right? Because even if you own real estate, you can be taxed on it, and you will be taxed on it, and boomers will be taxed on their real estate. Won't be long, in fact, like within 10, 15, 20 years, the pitchforks are going to be coming out. The millennials and the Gen Zs, I believe they're called, whatever, all the young generation, they're not just going to sit back and be like, yeah, we're going to just stay poor while you guys enjoy multi-million dollar homes, and we will rent and still be happy. Come on. You guys think that millennials are going to say yes to that? Property taxes are going to be a huge talking topic in the future. And it's not right. I'm not saying that it should happen. I'm not going to support the idea, etc., because, well, again, like I said, property rights are fundamental human right, and property taxing, just like, I don't know, it doesn't feel right. It just doesn't feel right. So, again, you can't tax Bitcoin, right? Yeah, Kusha thinks that the pitchforks are going to be coming out sooner than later. Yeah, I think the next, I think Insignium is right as well, that the next decade to 15 years actually is going to be a lot of, it's not going to be the best. I'm just going to take a quick washroom break. I'll be back in a minute. In the meantime, take a look at the dashboard that has been killing it. I hope you guys have been taking advantage of the dashboard. If you guys haven't, you guys are missing out on some really good trades. Be right back.
you be my baby, I got a ticket for a world where we belong. So would you be my baby? I would fly you to the moon and back if you be my baby. I got a ticket for a world where we belong. So would you be my baby?
So Richard Cardano has a good point. He says, people own music records, now rent. People own cars, now lease. People own now renting their homes, etc., etc. So that's a good point. What would you guys respond? How do you guys respond to that? What's the rebuttal? Is there a rebuttal to that? He has a good point. People used to own things, but now they rent and they're okay with it. So why not the same with homes? So Krisha says a home, unlike records and cars, is a basic human necessity. Krisha, someone could argue saying that a home is not a basic human necessity. Shelter is a basic human necessity, and if you can get that through renting, you want to own your shelter, right? So we're saying. So the answer could be something as simple as he has, so I want. Be as fundamental to human greed and relative need to what everyone else around you has, right? If everyone else owns a home around you, and or rather you're watching people who are wealthier than you own a home, and our human need for, especially if we claim to be in a capitalist society, or we claim to want to move up the ranks, eventually you are going to want to be a landowner as well. You are going to want to be a homeowner as well if you want to progress through life, especially if you are renting from someone who is a homeowner, right? The thing about renting music and renting a car, you're not renting it from you're not really renting it from a person. You're not renting music from someone else, because if you were renting his library of music, you'd say, hey, I just want to buy my own library of music, so that way I don't have to keep renting it from this guy. Now that's a really, really bad comparison, because music is really a different music is a digital good that again, this is not the right example, but you can still draw parallels there. However, this is where it gets interesting, Richard. Similar to a car, right? You're not renting from someone else particularly, you're renting from the leasing company. So if you have a disconnect between the person and or rather if you draw a disconnect, or rather you construct a disconnect between a person and an organization, to make it so that a person is renting the home from an organization, and more so doing or going through that mechanism and that dynamic, instead of renting from a homeowner where you are talking to the homeowner, seeing the homeowner be someone like you, then you can see people perhaps gravitate more towards renting, because what you're doing there is completely dividing the wealthy, the haves and the have-nots, in two different worlds, right? Because you don't have any connection with the actual homeowner, right? Because the homeowner is essentially a wealthy landowner who owns multiple homes and multiple units throughout the world, and is just renting it out to people that he never comes into contact with, right? Essentially like a corporation. So in that situation, that may start picking up traction, and in a way you could say that we already have that, right? Because at the end of the day, are you really owning your home when you take up a mortgage and you are paying it down for the next like 30 to 50 years? You're paying those interest rates and the principal amounts, and you're paying it, right? That could be really construed as you having a rent, you paying a rent on your property. Essentially, you are essentially, the way I like to look at that is, when you have a mortgage at a low interest rate, essentially it's turned into the same idea because of the long duration that you're paying your mortgage over. It is essentially as good as you saying, hey, I am paying a down payment in order to be able to have a lower rental cost, right? Because if you did not have a down payment on the house, or rather you did not buy the house, you did not take a mortgage on the house, your rent would have been maybe 2 times the cost, right? Maybe let's say the average cost of renting average mortgage is around $2,000 for a 4-bedroom house, and to rent it, it's $4,000 for a 4-bedroom house. Well, you could look at that as saying, hey, you know what, I've put in a down payment because I'll be paying this off for the rest of my life. I put in a down payment to be able to pay $2,000 for the rest of my life instead of paying $4,000 for the rest of my life. So it could really be looked upon the same way, because you don't really have property rights on your property either way when you are an owner, right? So I see what you're saying though. Pope says, I stumbled into a great conversation. Oh, you missed the best part of the stream was like the beginning part, man. Also the pendulum swing between landowners and rent seekers, or rather rentiers, people who are renting. I don't know what the word is for that. Tenants, I guess, tenants. That pendulum has been swinging for like centuries, back and forth. Where eventually, where does the term pitchforks come from, right? Where does the term pitchforks come from? It's from essentially the you say the pitchforks are out. Where does that term really come from? It's when the people who are farming the land eventually rise up against the landowners, right? That's essentially the pitchforks. They use their pitchforks, what they use to farm the land, to essentially go up and rise against the landowners, because things get a little bit too oppressive. As soon as people start feeling too oppressed with the rents that they're paying, and that's what's happening right now, right? At least in Canada, rents are going crazy, and people can't afford, even no matter how hard they work, their wages are not allowing them to catch up, right? When people feel that feeling of like hopelessness, they're not just going to lay back and say, hey man, I'm renting music anyways, right? What's the difference? They're not going to say that. And they don't mind renting their car. Honestly, leasing your car is a good thing, because actually I might be you may have a point that sits in line with another theory I was thinking of, but we'll get back to that in a bit. But actually, let's talk about that. Let's take the opposite side of this argument. So why is renting a car a good thing? Because cars depreciate in value because of technology. Technology is always getting better, and because your car is depreciating in value, combined with the fact that technology is getting better and the next model of the car is going to be better than your older model, it's always better to have the older model, right? So you don't want You don't want to actually hold on to your car for too long unless it is a collector's. Why are we still looking at the dashboard? Anyways, unless it is a collector's item, etc., etc. You don't want to hold on to your car for too long. You want to be constantly leasing your car, in my opinion, and get the best car available on the market, because security is better, its features are better, you'll be safe on the road, etc., etc., right? So similarly, if technology starts being applied to homes, right, and zoning laws are less restrictive, in the long term, in the future, maybe you don't want an old house. Maybe it is better to constantly lease. Maybe it is better to constantly rent, because houses are depreciating in value, because it's really the land. It's really the land that holds value. The actual house depreciates, right? So maybe we can go through that path in the future where people say, hey, F this, I want a modern home. And because technology is improving at such a volatile or such a rapid pace, I don't want to take the risk of having an old home within 1 year. My friend has a brand new home, even though like I should be having a better home than him at all times, because it's really hard to switch homes, right? So especially when you buy it, it's easier to just switch when you're constantly renting. So you could say, hey, you know what, I want to constantly lease a home so I can just pick up and leave whenever, because technology is allowing homes to be built like that at a rapid pace, and zoning laws have now expanded because of technology. It's a lot easier to have homes everywhere and anywhere. Who knows, we could be headed towards that future. Have you guys thought about just thinking out of the box completely like that? What if homes become like a car? So I'm going against my own theory over here, but we got to think about both sides of the argument, right? I'm literally coming up with these ideas on the spot over here, so if I'm saying anything ridiculous, guys, I do apologize. Yeah, Julian is completely correct. In a high inflationary environment, it actually makes sense. As the asset goes up, the debt gets inflated away. Exactly. You're right. These are all reasons to buy BTC if you think about it in the long term. Exactly. That you're right too. Exactly. Michael Saylor is right in that if you think about things through this perspective, Bitcoin literally has the combination of technology and property rights baked in one, right? What we talked about in terms of a home, gaining that, losing its value because of technology, and losing its property rights value because of technology. Bitcoin doesn't have that, because Bitcoin is literally a property item, a digital property item that will constantly expand its capabilities and constantly be, it's fungible, right? Unlike real estate is non-fungible. Bitcoin is fungible. If there is a new update on Bitcoin, there's new tech improved on Bitcoin, your Bitcoin is getting better as well, right? It's constantly going to improve with the entire network being improved. Real estate doesn't work that way, right? One home improving does not make your home as good as the other home. You may get some proximity benefits in that, hey, I'm living in the same neighborhood as all these awesome cool homes, right? But relatively, your home, you will still have to price your home underneath the home that had modern developments added to it, right? If you don't upgrade your home and you don't add all the technology benefits to your home can't be priced the same at the same rate, not in a rational way at the very least. And says, nope, your thoughts and ideas are much appreciated. I'm glad you guys think so, man, because I'm speaking from, I haven't really put too much thought into these things, but you guys get my ideas anyways. What's S&P? I'm not sure what S&P is. You mean SPY? Tell me the S&P index. We were talking about the S&P index for the entire first half of the stream, man. So we have like annotations and stuff that you missed. Richard says renting depletes cash flow long term because it keeps resetting to the cost. Exactly. To win your cash flow has to grow exponentially, get ahead, which simply won't happen for the vast majority. Yeah, you're correct as well. Unless we go back to the other theory, where we discuss technology having an impact on housing and renting as well, but the cost of renting actually gets cheaper and cheaper and cheaper and cheaper and cheaper, right? Making renting the winning side of the trade. We've just not lived in a world where we've seen that. I've not seen that. It's hard to fathom that. But what if that happens, right? You know how music has gotten so cheap, how information has gotten so cheap. I'm pretty sure there's a time where people could not fathom that world, right? If you go back to the 1910s, 1920s, where like I'm not sure how exactly they listened. I'm guessing those big ass records with those that what was that thing called? It comes onto the discs like that, whatever, right? They couldn't have imagined a world like this, right? Where we listen to music on the fly. Like I have like multiple music streaming services now. I don't even like it's gotten so cheap, guys, that I've lost track of the things I pay for, right? What if like we can't fathom it right now because it doesn't seem in the realm of what is capable right now with technology, but breakthroughs happen and then suddenly things change. The music industry is being fleeced and dying inside though due to cheap music streaming. That could be true, man. I'm not an expert on music. I barely listen to music. It sounds ridiculous while I play music to you guys, but I don't listen to like mainstream music, etc. all the time. I don't keep up to date. I can't speak on that. You could make the same argument for movies too, right? You don't see the quality of movies and even TV shows that they used to have. Maybe because of the same thing. I think Netflix has a huge role to play in this. Like, you're seeing such low quality garbage that they put out. I'm just like, how is this even on TV? Like, it's almost a crime to waste 10 minutes of my time having to sit through the first 10 minutes before I say, no, this is garbage. Like, you guys see the news Leonardo DiCaprio movie? I'm like, why would he say yes to this? And of course it's a Netflix movie. So maybe you have a point over there, man. On technology and housing, I'm thinking that the thought of being able to live in a mobile home on the road is actually a somewhat attractive idea. There you go. See, people are willing to accept these, especially with technology making that experience better, right? SpaceX has that what's it called, guys? The SpaceX internet, where you can essentially get high-speed internet from space. Space web or something like that, I forget off the top of my mind, but those things are beginning to start showing up, right? You're gonna see more and more and more of these. Yeah, don't look up, exactly, man. I tried to watch that. I really tried to go through that movie because it's Leonardo, right? Like, I'll give this guy the benefit of the doubt. But Jesus Christ. Starlink, yeah, thank you, Krisha, thank you, Philippe. Yeah. All right, we can talk about Bitcoin now quickly before I wrap up. Do you guys enjoy the entire segment on the history of how, I mean, we have more to talk about, but of course I think we're going to keep revisiting this. I mean, I have a lot to talk about in regards to, we could go all the way back to like 1950s, 1960s, go into the Volcker era, talk about the 1970s to the 1980s, 1980s to 1990s, then get into the Greenspan era, then talk about the Bernanke era. After that, we can talk about it all. We can go back to the 1910. Oh, I'm not looking at the right chart. I just realized you guys are still looking at the dashboard. We can go back to the 1920s, start right over there, leading up to the Great Depression, and then we can do an entire history session over the next year if you guys want. I'd enjoy it. Insinuum has a really good point. The more I own, the more I have control over my own life, and the less someone else has control over my life. A lot of times people want just that over renting, right? The ability for a landlord to just kick you out for various reasons, like, hey, I want to renovate, or hey, they could come up with reasons just because they want to take advantage of being able to sell their place, and they have the right to do that as well, right? Why shouldn't they be able to do that? But you don't have any rights as a tenant when they want to kick you out. Usually now, as soon as the government intervenes and starts adding tenant laws or tenant rights, etc., that's when it starts becoming less lucrative to be a landlord, and then you stop renting out your property. And then what ends up happening is you just have a lot of empty homes in your city, right? So there are all these dynamics you got to think of, but that's where owning has its advantages, because you don't have to worry about it. Richard Cardona says, yep, we should look back to see the future. Well said, buddy. Alrighty, so Bitcoin. My thoughts are that I think we will see something like what happened, again, not in terms of this price action, but you can see how we pretty much went sideways, down and sideways for most of 2018, right, in terms of SPY. I think Bitcoin could do that in a more bullish way, right? Because if you think about what Bitcoin did during 2018, it wasn't the best compared to what SPY was doing. Some of you who are here today were with us when we were trading Bitcoin in 2018. What did Bitcoin do in 2018? It was lower lows, lower highs, lower lows, lower highs, capitulation, right? I think it might be the opposite this time around, especially Nasdaq. If you compare Nasdaq and Bitcoin especially, I think we might see that with Nasdaq, where Nasdaq may see lower lows, lower lows, lower highs, and capitulation, while Bitcoin instead has I might be saying that right after it's already happened, right? Because if you use, like, for example, ARK, let's go to ARK Innovation. Yeah, look at that, guys. What the, wait, what? Wait, I'm not being. This is actually holy shit. So if you think about that, guys, okay, this could be 2018. Bitcoin's 2018. Right? And on the flip side, what did Bitcoin do? If you guys think about it, Bitcoin made a higher high. Right? Let's put up a fresh chart. Bitcoin made a higher high, and it's yet to make a higher low. Sorry, it's yet to make a lower low. In fact, it's yet to make a lower high, lower low, right? So Bitcoin is, like, if you look at the structure, this is completely different. This is showing strength relative to this. Would you guys agree? Would you guys agree? I think we would all agree, right? And this is very similar to what Bitcoin did over here, and ARK has done over here, right? Right? Is this not the same as this? So like, that's what I mean by what I was talking about may be playing out as I say it or may have already been played out, because this is what I was going to say. I was going to say, I think NASDAQ is going to do what Bitcoin did over here, okay? And Bitcoin is going to do what SPY did. You know, it's, I need another tab. Okay, we'll get rid of this one. I'll pull up SPY over here. SPY. And Bitcoin may do something like what SPY did over here. 2018, yeah, over here. Okay, this is where it gets super interesting, because damn it. I was going to say, where Bitcoin does something like what SPY did over here, right? Goes sideways and then one last down thrust and up. But if you think about it, Bitcoin has already done the first half of it, where we've gone, put in a higher high, because look at SPY. SPY put in a higher high over here, guys. Okay? Then went down and then up, right? Bitcoin's already done that. We already put in the higher high. What if we do this and then this? Ooh, Krisha, this lines up with your theory. Krisha had a theory that she's been running by me over and over again, where she thinks Bitcoin is going to break this M over here. Doesn't see the continuation, right? So she thinks we're going to do something like this. Break down temporarily a bit, test 24K-ish, and then up. Right? So we don't see the full continuation of the breakdown of the M. And that looks like what? What SPY did here. And this lines up, and I'm not looking at fractals over here, by the way, even though it's lining up with fractals. I'm looking at the dynamics of what the Fed is doing with the money flow, etc., with where the markets are, where the money flow is going towards in terms of market strength. Because what we have seen over here is Bitcoin shows strength, while NASDAQ and especially ARK, etc., proxies for these growth stocks show weakness, right? So if Bitcoin is considered an emerging tech, it is essentially a growth coin or growth asset, risk asset. It's not showing as much weakness as ARK, for example. Do you guys see what do you guys, what do you guys think? Yeah, it's not unreasonable at all, Marin, I agree. Backfilling Krisha's theory, says Richard. Yeah, like it's all lining up. Love it. Love it. Okay. So this is how I'm most likely playing this year, guys. And I reserve my rights to change my change how I approach this, of course. But for now, and I'm very certain I'm going to stick with this for 95% of the cases that we see, or rather until I see the right validation. I'm really tired, but I want to wrap up with this. My base case for this year, okay, I think this is the best way I can put this. I will not be buying Bitcoin unless it is underneath $38,000 or it's above $65,000. Okay, I will only be trading Bitcoin between that region. So I'll be trading Bitcoin in this region, like leverage trades within this region, right? In terms of my spot buying, I'm only buying underneath 38,000 to 36,000, underneath that region, or above 65,000, right? In terms of spot. So I'm willing to buy spot above 65,000, and I'm willing to buy spot underneath 36-ish thousand. Does that make sense to you guys? And do you guys know why? I think I'll expand on that in the next video I do, because I'm tired, and I feel like if I go on any longer, I'm gonna, because like I mentioned at the beginning of the stream, not feeling the best today. But any questions before we wrap up today? Mock is back just as I wrap up. Mock, maybe we'll play some DVD. Ugh. Exactly. I'm willing to buy on strength. I've bought near 60,000 twice now. I'll do it again for the third time. But these were leverage trades this time, right? Both of these leverage trades. Luckily, we have our risk management in place, and we are wrong very, very quickly as well when we get out. But yeah, same story. This time when we buy at around 65k, 66k-ish, again, it really depends on how our market structure develops. It could be higher than that, right? So most likely not lower than that. Very unlikely that's going to be lower than that. Like very, very unlikely. But I'm willing to buy higher than that and be more comfortable buying at like 70,000 than 60,000 for that matter, because my base case is that Bitcoin could range, right? Bitcoin could range in this region over here. And this entire region, I don't know how long it's going to range for. It could range all the way leading into 2023. Maybe it could range for all the way into 2023, leading to 2024, right? We don't know how long it's going to range for. So I'd rather use my liquidity as margin than be trapped in a spot trade at resistance. So I want to buy well above resistance and then use my build up my margin accordingly. Does that make sense? Question for the gang: Can we have a hands up for thanks for Sean and Krish helping us? Keep saying it. Thank you so much, Pops. Appreciate that, man. If you guys haven't yet, hit the like button, hit the subscribe. Damn, it's been 2.5 hours. No wonder I'm so exhausted. Appreciate that, guys. Take a minute take around 10 seconds to leave a comment underneath the video as well, just to just do it for the algo. Oh, by the way, did you guys catch the trade I mentioned on Krisha's video on Bitcoin, where I said we're testing 38,500-ish? It was that 12-hour divergence play. It hit to the T. 3,800, actually almost hit 39,000. So that's a good trade if you wanted to trade that. High quality or quantity, says Julian. Awesome. I'm glad you guys are enjoying this, man. Really glad. I was a bit worried that you guys may not enjoy this kind of content, but super happy to hear you guys enjoy it. Today I wasn't able to do my best, so I do apologize. Thank you, Hostler, man. Next time, hopefully, we'll have Krisha on here too. Ooh, someone asked for Neo before I wrap up. I won't forget. Hey, it's following my drawings from a while ago. Just a bit late. Oh, no, to the T. Look at that. I drew this. Halfway there. These are my thoughts. This is what I was expecting it to do when it was somewhere around here, I think. So yeah, $2. I don't know. I have no long-term targets on this. But if it breaks this level here, let's look at the daily. Do I click that? Yeah, breaks $7.50, likely coming down. So yeah, man, if you're still here, gotta be careful. I'd be careful with all coins, man. I'd be careful with all coins. A scribble is legit. Yeah, man. The squigglies. Don't underestimate the squigglies. Keep an eye on Bitcoin dominance. All right. Gonna wrap up though. Oh, come on, Bitcoin dominance. Ooh, okay. So Bitcoin dominance is at a level, a resistance level. So maybe all coins see some relief over here. I'd watch out for this. So next week we may come poke up over here and then see a rejection. What do you guys think of this theory? Oh, if you're still here, who was it from the seed program who asked about this? It was Sachin, right? Sachin asked about Bitcoin dominance. So yeah, Sachin, these are my thoughts on Bitcoin dominance. I'll expand on it a little bit more in a separate video. Again, I apologize for not spending more time on this. You keep asking, and we just keep not having the time to talk about this. But yeah. Do you guys want Mark on the stream? I want to get Sherwin on the stream for sure. Mark would be too shy. If Mark says yes, I'll bring him on. What do you guys think about having seedlings as guests on the stream every like bi-weekly kind of thing, you know, every 2 weeks? I'm wrapping up the stream now. Let me know what your thoughts, what you guys think about that idea in the comments down below. You know what that means, right, Sean? That means you're gonna have to come on too. You can't say no or be shy about it. You did great, Mr. Mango, says Krisha. Making me blush. Does that mean I get to take you out on a date? Look at Mark. Mark is so shy. I completely missed the clubhouse stuff. Let's start the clubhouse again. You guys have been doing the clubhouse without me. No, Tan, I completely disagree. In fact, it's the embarrassing moments that we should be talking about the most. Being an accomplished trader makes it a lot more difficult to remember your mistakes from the past, unless it's the most painful ones, right? It's really hard to remember those. Once the habits are getting ingrained in you and you start doing things on autopilot, it's hard to remember all of the things that you struggled with. The big things are easier to remember, the big mistakes, but I think it's a lot easier to learn from someone who is in the midway between his path, in terms of listening to his struggles at the very least. So I think it's those embarrassing moments that makes Mango, because we talk about that all the time over here. Cheers, man. Yeah, guys, I gotta head out too. It's already been 2.5 hours now. But with that, hope you guys enjoyed the stream. My name is Sean Dexter. Until the next one, do the Mango way, do the easy way, do it the stress-free way. Ciao. And end stream. There we go.